Hi, everyone, and welcome to this week's webinar. I'm Tom Wilson. I'm the Investor Education Specialist, and I'm joined by Mitchell Snedden, our Head of Portfolio Services. Welcome, Mitch.
Thanks, Tom.
And we're looking at the investment selection made easy process today, trying to break down some of the jargon around diversification and also getting into different portfolios that InvestSMART offers. And just as always, a disclaimer, we provide general product advice only, not any type of personal financial advice.
So we thought we'd get things kicked off today with a quick update from InvestSMART's market strategist, Evan Lucas. Of course, a little bit happening today in the world of finance here in Australia with the government announcing the new RBA governor. So we'll bring in Evan just for a quick update.
Hey guys, hi. Just a little bit going on right now. I can tell you right now, it's been one of the busiest mornings I've had in a long time, with everybody asking me questions about what it means and how the RBA sort of goes. I mean, for those of you watching, straight and foremost, what does it mean for you in terms of your portfolios? I think that needs to be pointed out. Michelle Bullock is a very safe pick. And why I say that is that it goes with tradition. There's been 8 governors in its over 60-year history, and 7 of them have come from the deputy position. So only Bernie Fraser back in '89 was the only one not to have gone through the standard movement of being inside the board, understanding the board, how the bank works. So she's a very safe hand. I mean, she's been there for 38 years as well. I want to point out very clearly that in terms of what happens in the short term, there will be no change to what you experience. And therefore, the expectation about rate movements, forward guidance will be pretty similar to what we've already seen. It's not going to change in the interim. By interim, I mean probably going through to Christmas. But Mitch is right. What's also interesting about it is that the change it brings will be next calendar year. She is already clear in her view that she's at the peak, which is probably good for her. She'll get a honeymoon period. And calendar year 24 and realistically FY25 will be different. It will mean that the possibility of allowing the break off, allowing expansion, and therefore growth to really start to happen is clearly on the cards. And she will be very aware of that. So that is why today was so interesting. It shows that she's going to have a clean slate and that the start of her 7-year tenure will be much different to what we've seen in the last 3 years of Philip Lowe. She will have the ability and the air to start moving towards growth into the future.
Yeah, and she's been at the table for all of these conversations, as you said, for 38 years. So, you know, it should be more of the same, really, of what we're seeing. So putting that lens on it, Evan, let's take a look at the outlook right now for the dividends and growth for our InvestSMART diversified portfolio. So, you know, from our conservative through to our high growth.
So the question about dividends is an interesting one. And the reason I say that is FY23, which has just finished, we are 2 weeks away from seeing the start of full year FY23 reporting season. Dividends are actually going to be interesting because I think they're going to be pretty healthy, but they're going to then give you a forward-looking expectation that don't expect those dividends to be held next financial year, unfortunately. And why that is the case, you know, it would be prudent for companies to start probably just making sure they have cash on balance sheet to actually mitigate what we're seeing at the first half of this calendar year, which is that we're seeing slowing sales. There's always an argument. Free cash flow is the most important thing to a company. And why this matters for you guys in your diversified is that, you know, the top 200 companies that you use inside the IOZ ETF, which is the representation of the ASX, these companies are thinking about FY24. They know that the slowdown is on. Therefore, dividends are probably going to be the one to see a little bit of a head going forward. What they are pointing out, though, is they're not as concerned about the outlook for growth as they probably were even a little as 4 months ago. So you can hear that from BHP, you can hear that from Rio. They're the growth companies to sort of look at in that space. You then also look at what's going on inside tech and the absolute incredible movement that's going on from AI. So the growth part of your portfolio is likely to come through capital. It's likely to come through capital movements, not through dividends. And that, I think, is what they're going to tell you is that here's your really chunky dividend for the end of FY23. Don't expect to get that kind of dividend in FY24. We're ready to go, finger on the button for the expectation that growth will start to pick up this financial year. and rates are going to start moving. Inflation's going to come back in line. So the second half of the financial year is what will be really interesting. So for those in the growth, ethical growth, high growth, that's my view. For those of you in the conservative space, particularly, I know it's been a tough period. I know fixed income has been all over the shop. But what we just talked about before with Michelle Bullock, but not just her, across the globe, rates are peaking. All of that fluctuation that you've been seeing in the bond market, all of that, concern about, are we going to go through a recession? Is, inflation going to get stuck? Are we going to have this stickiness that's going to move that all around? That in the last 4 to 5 weeks has started to really dissipate. And the US particularly has shown you that inflation will come down. Inflation, not only will it come down, it'll get back into level. So fixed income markets, there's a lot of people who are actually suggesting that it's going to be a really interesting, in inverted commas and not advice, exciting part of the market in FY24, because there is potential there. They are trading at discounts to face value. The yield on them is well and truly above what we would normally expect. So those of you in the conservative side of your portfolios, expect your fixed income to finally come back to where it should be, rather than being the drag that it has.
Fantastic. Thanks very much, Evan, for joining us there, mate, and for giving us a quick rundown. We'll let you get off to probably yet another media.
Yes, unfortunately so. Cheers, guys.
Thanks, Ev. Cheers. Bye.
All right, Tom. So off the back of that, let's jump through to the next slide here. Bring up the portfolio returns for the InvestSMART diversified portfolios.
Sure.
And as people can see, the last 12 months have actually been pretty strong across the board. So if you're looking at the InvestSMART high growth, you've got a 14.6% return over the last 12 months to the end of June. So it's a really, really strong year, despite what we were all seeing out there. But I'd hate for investors who did jump in and get that 12-month return to extrapolate that. That is an exceptional return. If you look at the since inception numbers of that 7.7% per annum, that is more along the lines of what investors should expect long term from a high growth portfolio.
And that's December 20. Since inception.
December 2014.
Yep. Okay.
So next year will be 10 years of these diversified portfolios, except for ethical growth, which is pretty brand new.
Yep.
So this is using this as a bit of a backdrop as to what we're going to be talking about today. Tom and I are going to get into breaking down how you actually go about choosing a diversified portfolio. Absolutely every Australian, if you've got superannuation, which is essentially every Australian with a job, has got some form of their money going to superannuation.
Some even have millions and millions in there.
Some people have a lot of money in there. Then you're faced with a couple of decisions to make, and you're faced with a few names to choose from. And that's either, if you're looking at our portfolios, if you're looking at your industry super fund, you'll be seeing the likes of conservative, balanced, growth, high growth. It could be called moderate or aggressive, or I think there's nothing higher than aggressive. I haven't come across any. And so what we're going to do today is go through these names, break them down so you can, if you're looking at the InvestSMART portfolios, make a good decision about the InvestSMART portfolios. But if you're looking at generally speaking, at a diversified portfolio around Australia, what you can expect and how you can, a couple of tips to choose the right one for you.
The next slide there was just talking about the single asset class portfolios as well, that have a specific mandate or function just to give you exposure to a certain asset class.
That's right. So we will go into a little bit how and why you might use these individual asset class portfolios. But I do understand, like, most of our investors are invested in our diversified portfolios, but there are a good number of you out there that do just hold some of these single asset class portfolios. So we'll talk to that a little bit later on.
Okay, so we'll go on to now some of the exciting parts of the webinar, I think, talking about what are the actual portfolios made up of. And you can see that there's a lot of information even in here, even on this one little screen. So I might even just get rid of my picture there. And what we try to do at InvestSMART is to at least, we let everyone know what's actually inside them. So we don't hide or skirk away from the idea of what we hold. We publish it on our website. We put the asset allocations in as well. So we let you know what percentages we're allocating to different asset classes. So, clients will come to us and say, conservative fits my goals, my time frame, my risk profile. I want a portfolio that's comprised of those percentages. And you could do this yourself if you wanted to. We publish all of the ETFs what we use, but the reality is that if you don't have the time or the expertise or putting together the tax statements or even handling rebalancing, which is an integral part of investing, that's what we do for you. So looking at this quickly, there's a number of different asset classes there. We've got the cash component, because cash is always an interesting or integral part of a portfolio. And we, in fact, use the BetaShares high interest ETF, which is AAA. That's the ticker code. So you can go and research these yourself individually if you want to. They go through all the different lists there. You can also go to the web page itself, the InvestSMART Portfolio. So I'll put a link up so you can see all of the portfolios. But you can see here how we literally are taking ETFs that suit our purpose and our client's purpose, and then put them in the portfolio to give exposure to that asset class.
And you will notice all these ETFs as well are passive index tracking ETFs. We want to, when putting together a portfolio here internally, we want to get the indexed return for these specific asset classes. We've just heard that our sound is cutting out from time to time, so I do apologise. We'll try to.
I think it might just be because of the earphones that we took out.
Right.
So we could hear Evan Lucas.
Yeah, so we could hear Evan. Our apologies. Anyway, I'll continue on as Tom fixes that up. So we use passive ETFs because we want to specifically get that asset class return. So if we jump down to the next slide here. So when you're looking at conservative, balanced growth, high growth, as I've said, other places might call it moderate and aggressive, things like that.
60-40 and
60-40, yeah, they might give numbers. So what are we actually looking at? Essentially, we're looking at, especially in our world, we're looking at a portfolio that holds the exact same assets so a conservative portfolio holds the exact same assets as a high growth portfolio. The difference is how we blend those. So just like a winemaker would blend different grapes in different quantities to create a different blend of wine, here we are in a portfolio where we're using the same ETFs as we are in the conservative, as we are in the high growth, but just different percentages of each. So in the conservative portfolio, we have a much larger allocation to bonds and cash, so those defensive asset classes. And then in balance, you go almost close to 50-50 split between defensive and growth assets. Now, growth assets we call Australian equities, international equities, and infrastructure. Property. And then as we go up, you can see the high growth is almost a mirror image of the conservative portfolio there. So you've got way more exposure in the green section that you're seeing there to international equities. And it's really important to have that international exposure in there. And you've got then that blue segment there is Australian equities. So you've got about 70% split between those two asset classes. Right. So how do you choose the right one, Tom?
Yeah, well, we do run a course here at InvestSMART called InvestSMART Bootcamp, and it literally does take you through the entire process from budgeting and saving, investment planning, choosing a goal, understanding time frame.
When we say we, you.
Well, me. I look after that. And we've actually just launched a brand new InvestSMART Bootcamp for business. So if you're someone who owns a business, or even if you think colleagues might benefit from having a bit more financial well-being improvement, then it's a course where we can offer bulk enrollments to anyone interested. But basically, we go through and we talk about defining goals. And this stuff, it can seem a bit boring sometimes, but it's literally the bread and butter, and it's the secret of boot camp. Are you going to say it's not boring?
No, defining your goals are really, really important. A lot of people, if you have a clear goal, like anything, if you have a clear goal, you can set a clear plan and path to that.
Yes.
For example, I'm unfoolishly booked myself in to run the Melbourne Half Marathon.
Oh, okay.
In October, so I've got that goal. I've now got a clear runway of all the training I need to do, thanks to a handy app, to actually be able to reach that goal.
So that might be an example of choosing the inappropriate time frame. But a good example going through here is, as Mitchell said, defining your goals. So I might want to save up for a home loan deposit. In my head, I've given myself 3 years to do it. So that's given me a time frame straight away. Then I can look at trying to match that to a proper portfolio. But it's good to understand your tolerance to risk or your risk profile. I'm someone who's fairly comfortable because I understand that markets will go up and down. That's the whole reason why I'm investing money. I just don't want to put it into a term deposit where I'm going to earn a certain amount for a very short period. I want it to actually get some growth. So I'm going to dip my toe into the ocean of risk and reward and see what happens. And hopefully by matching it to my time frame and risk profile, over the long run, I should get ahead. But
and when you're actually, sorry to cut in there, Tom, when you actually are looking at investments, and be it our portfolio or just about any managed fund I've ever seen, they they'll have a box in their product disclosure statement or on their website, and it'll actually have recommended time frame. Pay attention to it. It's not just there because it's a compliance thing or a regulatory thing that they have to have there. It actually the time frame tells you a lot about the risk involved in that investment product. So the longer the time frame, the higher risk associated with it, because you need to allow yourself that time in case you have a negative return, so it drops in value. You need to allow yourself that time to make it back up.
Yep, absolutely. And it's also important just to try and, in your investment plan, so putting together a sheet of paper or Excel doc or a Word doc, and just go through and ask yourself questions. How would you react to a market drop? So in March 2020, during the COVID pandemic, we had a drop in the markets worldwide, about 30% in some cases. And that's just a temporary repricing or valuation of your holdings. It's not as if that's suddenly what you're left with. It's only left with that if you decide to go ahead and liquidate or crystallize that. And we've gone through previously talking about market timing and how we're horrible at it as humans. No one can do it properly. Even the analysts out there are in the same boat.
Yeah, so just kind of to summarize that page, the time here at InvestSMART, we put a really heavy emphasis on time frame. So that to us is number one. When selecting your portfolio, think about the time frame of your goal. The closer you move towards that goal in time frame, you should drop down the risk profile. So you should realign yourself with a portfolio with a similar time frame. So if you've got a 10-year time frame in mind for your goal, when you get up to year 7, your time frames are only 3 years. So you don't want to be in those high risk assets that are going to come along and give you, say, a shock just when you're about to reach your investment goal. So you want to be dropping back down that risk scale as your time frame changes. So time frame is number one for us. But then secondly as well, you know how you might react. We certainly know how some people react when the markets get choppy. Some people do really panic. Some people do
the opposite, and they say it's an opportunity to.
Some people get really calm and really excited. Other people get really despondent and quite upset at us. And so, but you, as I said, you. So, second thing from the time frame is how you are going to react to risk and to a negative return in the market. Now, your time frame might be saying to you to be invested in high growth, but that might not be a level of risk that you're 100% comfortable with. So perhaps to save yourself from jumping nervously and jumping out of the investment at the wrong time, perhaps even though the time frame suggesting high growth, perhaps a growth investment might be more suitable because you're going to be more comfortable holding it for that long time. So you're going to have to take it's a bit of a trade-off there, because you are going down the risk scale and you are decreasing your exposure to growth assets, but you're doing so to keep yourself in the game for longer despite the bumps. So they're the two things that we focus on here at InvestSMART, and two things that we suggest people can help people focus on investments outside of us as well. So
just lastly, there's the risk tolerance questionnaire. So if you were to sit down with a financial advisor or planner, they take you through, this is like their bread and butter. There is a version, a statement of advice tool on our website that you can use and get a bit of insight into what you could look at in terms of investment products.
Yeah, so underneath this, in this article, when we are finished with this webinar, what we'll do is put up all the links that we mention in that article, so you can jump straight to the statement of advice and give that a go. It's really comprehensive for a digital statement of advice. I think you'll find it surprising. So what we've put together now, I quite often think of the best way to look at what to do is to focus on what not to do. So we've put together a couple of case studies, and these are actual real case studies that we have seen play out of the wrong thing people do when investing in these diversified portfolios and when choosing these diversified portfolios. So I've gone in one direction. Tom's gone in a different direction with his. This is my one, the commitment phobe. I asked the team who's a classic example of a commitment phobe, and
they said you.
No, Jerry Seinfeld came up. I Googled how many girlfriends did Seinfeld have in the whole series of Seinfeld. I think it's 76.
Wow. Okay.
Yeah. So anyway, chops and changes all the time. That's the commitment phobe. So I've actually got a chart up here, and this is an actual chart from someone who had invested with us in the past. And as you can see, this is showing funds added and removed. And so also during this time period, this particular investor chopped from when things got when things got ugly, he chopped down to conservative. When things got rosier and excited again, he jumped up to high growth, and vice versa, and just kept on doing that. Now, the only person that this investor made happy would be the brokers, because you're transacting a lot, you're jumping at the wrong time. You're not paying attention to your timeframes at all. These portfolios are designed to wear those bumps, but by cutting down to a conservative portfolio after things had fallen, essentially all you're doing is locking in those capital losses, and jumping up to a high growth portfolio after things have risen, you've missed that run anyway. So once again, you're selling those other assets and just following along. So that is, to me, it was one of the worst examples of something someone can do. These portfolios are designed for the long term. Once again, hold them for that time frame, and you need to be in the markets to get the market return, even when things are ugly. So you have to follow your planning, follow your process, and commit to it. Just like a relationship, through good times and bad, unlike Jerry here.
Yeah, Jerry and his 76
Jerry
attempts.
and his 76 girlfriends.
I guess some of the case studies that I've seen and I've used, it comes down to even the term conservative. And as Mitch went through at the start, different investment companies or even super funds can refer to as conservative as a different meaning. And that can sometimes get lost in people's own world. So in this case, I spoke once to a couple who'd always been invested in a conservative portfolio their entire life. And it's because they understood the word conservative to do with their personal lifestyle or belief. So, it reflected cautiousness or restraint in daily life, traditional values, example, and that's doesn't translate like that across when it comes to risk portfolios. What it's trying to say is that a conservative portfolio is heavily weighted to defensive type assets like fixed income, cash at bank, or cash type products, but they still will have some growth. So in this example, they had pretty much left money on the table. So in a diversified portfolio, and they had a very long time frame, they would have been well suited to a higher level of risk in terms of high growth or growth. And they pretty much have missed out on all that overseas growth through international equities, let alone Australian equities as well.
Yeah, and so one thing to keep in mind, the naming conventions in finance with across conservative growth, high growth, it's about how they compare to each other. So just because something's called conservative doesn't mean you're not going to lose money or your portfolio is not going to go down. It's just it's comparing it in the blend of the risk, the growth and defensive assets comparable to balanced growth and high growth. Yep. That's where the naming conventions come from. So jumping down to my next one. So I stuck on the relationship train.
Yep.
The polygamist. So this does happen from time to time with people who first open up an account with us. They come along and think they're getting more diversification by holding all four diversified portfolios. So they'll say, I want a diversified portfolio, and they get 25% conservative, 25% balance, 25% growth, 25% high growth. Now, you're essentially just holding the same assets as I've explained earlier. It's just the blend in which the way that the portfolios are blended that's the difference. So if you actually throw all these portfolios into a blender and come out with a 25% split, essentially you're kind of going to end up around the growth portfolio, just a shade, basically just a shade above the risk profile of the growth portfolio. So we would suggest people to choose a single portfolio that aligns with their time frame. There are the odd occurrences where multiple portfolios would suit you, but in most instances, we would suggest to select the one, the growth, high growth, or balanced or conservative, not a combination of them all. You're not getting any more diversification. And already in these portfolios, you are incredibly well diversified. So, for example, the Australian equity exposure, we use the ETF, Exchange Traded Fund, the iShares S&P ASX 200 ETF. Now, IOZ is the stock code for that, as Tom's mentioned earlier. The 200 in that name is a dead giveaway of how many holdings it has. It holds 200 businesses. If you look at our international exposure in these portfolios, which is through the Vanguard International Shares Index, that holds, I think it's close to 1,500 of the world's largest companies.
Yep.
So you are incredibly well diversified just by holding one of these portfolios. You actually do not aid to your diversification whatsoever by going across all four. Now, as I mentioned, there are times where you would hold multiple portfolios. And that's, we've got a couple of examples here. That's when you have different goals. For example, you might be using a common retirement strategy is the bucket strategy. And that's where you've got three buckets of your assets. So you've got a cash bucket or term deposit bucket. So something that's highly liquid. And that's your here and now, and that's for your everyday expenses. And a lot of people, I was reading an article by Theo on the Eureka Report just yesterday, talking about how to prepare for a recession, and he spoke about the here and now bucket, essentially saying that he advises his clients to have 2 years worth of expenses in that bucket. You'd then have a medium term one for generating income and modest capital growth. And so that could be, say, for example, a balanced portfolio. And then you have a longer term one to provide growth because people are living longer and you need that growth to keep up with inflation. and you want that bit of capital to provide for you down the future. And so that could be a high growth investment, because that particular pool of capital you might not be tapping into for 5, 6, 7 years. So that is an instance where we do see people successfully blend the portfolios to fit in, because they've got those 3 buckets, 3 different goals, 3 different timeframes. And the other one, and this was touching on those individual asset class portfolios that we have, people use a core and satellite strategy. So, for example, we could get some people who have a very high risk profile, and they might hold 70% of their portfolio in the high growth portfolio, and then add 30% of it in the international equities portfolio. So that's a very high growth portfolio. They could have a positive long-term outlook on international equities. That's another portfolio that we'd have a 7-year plus timeframe recommendation on. So that's an instance where someone may hold multiple portfolios in a suitable fashion, not just diversification for the sake of diversification.
There was meant to be another slide there, wasn't there?
Was there?
One I was going to just talk about someone who picks the growth or the high growth portfolio, but has the inappropriate time frame. And it was just the example of how when people come to the website and they see, whether it's ours or others, they'll see all of the past performance, and they might go straight for the high growth, and they'll look at it, performing even for what the last year, performing a fairly high number, like double digits.
Yeah.
And they make the assumption that prior performance, past performance, is indicative of future performance. So one particular person I spoke to once had a 1 year time frame, which is incredibly short.
Yeah,
and
you're keeping that 1 year time frame. You're keeping that in cash.
That's it,
because you've got no idea what's going to happen tomorrow in markets. No. And you're allowing yourself no time to recover.
That's it. So if you had have actually done that, say February 2020, you would have been in a world of hurt because of that 30% drop. But I try to explain that just by having your money in that for a year doesn't guarantee that you're going to get that larger return. It could be negative. It could be so over that 7 years, it is going to be volatile because it's exposed to assets like growth. And also, overseas growth, international equities, and also here domestically. And there was a question there from Sandra. You did the boot camp 3 or 4 years ago. That's excellent. Boot camp's only for 3 months. So you've got access to 3 months, because to be honest, over that 3 or 4 years ago since we've launched it, it's changed dramatically. It's evolved. It stays up to date. It's even added modules into it. You can even ask your workplace if they'd be interested in purchasing a bulk amount if you have that option. And you can actually go to that. I'll just show you if you like exactly. I'll just share my screen. And if you go to the InvestSMART website at the very bottom, because it's still sort of in the let's get excited, get ready for it, bootcamp for business here at the bottom.
Or if you do go to the normal bootcamp page, there is a banner that'll come up to take you to the bootcamp.
We did do that, didn't we? Yeah, excellent. Where we do know what we're doing. Oh, there's a picture of me. There we go. Tom. Oh, yeah, great. Okay, I'll just stop that, and we'll come back to our last part here. Excellent.
Great. Okay, so one thing people can do is talk to the team here. So myself and other Mitchell are available to book times with to have a chat with us about our portfolios. If you're a current investor and you have some queries about your portfolio, we're more than happy to talk to you. There is once again some links that we'll be putting on the page once we've put this webinar up live on there. So come back there and you'll be able to find them, or just email us invest@investsmart.com.au. And just request a phone call, or send through your questions as well via email. We're, as I said, more than happy to have a chat. On that links page, I'll put up the core and satellite approach article that we've done. got an article about that bucket strategy that I mentioned. And there's some links to the bootcamp. There's some links to investment planning, links to our help center. So we'll put all that information up there.
Sharon's just asked a last minute question there, asking
Sure.
about time frame. Is this referring to when you want to access the funds or go into the pension phase?
The time frame would, if we're referring specifically to that here and now bucket, that time frame is referring to when you are accessing the funds.
Okay.
So it's saying to have that 2 years worth of cash in your portfolio, so you can, no matter what happens in that short term, that you've got in the next 2 years of expenses covered. Because, generally speaking, if markets do pull back, the corrections tend to be at the moment quite short. And so we are seeing that recovery happen. But also in that 2 year time period, your other bucket, your secondary bucket, income's coming out of there from dividends. And that can be going to topping up bucket number one. So, now, thank you very much, everyone, for joining us. You might have noticed Tom and I are using some different software today to do this. So if you have any feedback, please let us know as well. Send it through, once again, to us via email, invest@investsmart.com.au. If there's any topics you want covered, any additional questions, just let us know. But thank you once again for joining us.
Thanks so much. And we'll see you next time, and hopefully using the same software.
Yeah, I think it went well.
Oh, yes. Thank you.